Let's quickly talk about the overview, what we are trying to accomplish here. We are trying to evaluate implementing a certain project is worthwhile or not. We're going to eventually compute NPV of that project. In order to compute NPV, we need to know cash flow at each time. How much you're going to spend initially and what's the cash flow you're going to get in the future. When we compute cash flow, we're going to take the following approach. We're going to do this one in two steps. In the first step, we're going to compute so-called unlevered net income. Because these are accounting profit, not in cash, in order to get the cash flow, we need to make some adjustment. So we're going to add depreciation back. We're going to subtract capital expenditure. We're going to subtract increase in net working capital. This is the approach we are going to take. We are using this Cisco example during the class. Based on these informations, we derive the unlevered net income first. So I explain how to get the sales revenue, operating cost, selling general admin cost, R&D, depreciations. I explain this table and the next table to get unlevered net income. That's the first step. And then I explain about why we want to add back depreciation. Basically, this is non-cash expense. So we include that to compute accounting profit in order to compute tax. So you're going to get some tax refund from depreciations. So we subtract depreciation before, but we need to add back depreciation because this is non-cash item. And then we need to subtract capital expenditure. You are buying some equipment at t is equal to 0. That's the cash outflow. So you need to subtract that. And then I explain about why we have to reflect changes in net working capital. Net working capital is the current asset minus current liability. So I explain using this example, the increase in account receivable. Increase in account receivable means you sell your new good in credit. So even though this one was accounted when you compute accounting profit, this is not the cash revenue. So when you try to compute free cash flow from unlevered net income, you need to subtract non-cash revenue. Increase in AL is same as the non-cash revenue you included to compute unlevered net income, so we need to subtract it. Anyway, I explained everything about this one during the lecture, and I also emphasize that this is not accounting course, so you're not supposed to compute each element of net working capital to get this number. I will give you this number to you directly in the exam. Something like this. There will be net working capital change of 2.1 million, increase in year 1, and this will be reversed in year 5. So you need to subtract 2.1 million in year 1, and you have to add back 2.1 million in year 5. And then the cost of capital for this project is given as 12%. So once you are able to get the free cash flow by adjusting unlevered net income with depreciation, capital expenditure, and change in net working capital. So you're going to get these 5 from that adjustment, also the initial cost. So you're going to get cash flow of day and all the period up to 5. Given the cash flow, you're going to use this discount rate here to compute NPV value. So let's reflect the depreciations and capital expenditure and change in net working capital to get free cash flow. So we already know these numbers from previous computation of unlevered net income. Now we need to add back depreciations every year from 1 to 5. You subtract 1.5 million, 1.5 million from year 1 to year 5. You need to add back 1.5 million for each period up to year 5. And then because you spend the $7.5 million to buy an equipment at t is equal to 0, you need to subtract that amount here. So parenthesis means subtract. And you also need to reflect the increase in net working capital. There will be increase in net working capital 2.1 million at year 1. So you're going to subtract that here. And this will be reversed at year 5. And then once you reflect this one, 12 million loss plus 7.5 million capital outflow, you will get 19.5 million cash outflow at t is equal to 0. If you reflect adding back 1.5 million and subtracting 2.1 million here, your free cash flow at year 1 is going to be 7 million. Likewise, just adding back 1.5 million, 1.5 million, 1.5 million, you get this number. Finally, at year 5, because of depreciations, even though this project doesn't generate any sale revenue, you still get tax refund because of implementing this project. Also, you need to add back these depreciations. Also, you need to reflect the decrease in net working capital here. So after taking into account adding back depreciations and the decrease in net working capital, you will get $2.4 million as a free cash flow at year 5. Once you get free cash flow, the cash outflow initially and then cash inflow like this, you need to compute net present value of this one. So when we discount this cash flow, we're gonna use 12% discount rate. So what is the NPV? NPV is the minus initial cost, $19.5 million, and free cash flow, 7 million, 9.1 million, 9.1 million, 9.1 million. 2.4 million here. Did the discount by 1 period, discount by 2, 3, 4, 5. So if you plug in all the number, eventually you're gonna get this number, which means NPV is positive. So you have to accept this proposal. Now let's talk briefly about poll 2.2 questions. In these questions, Hewlett Packard HP introduced a new laptop with a product life cycle of 4 years. The annual revenue, operating cost, admin cost are given. $1 billion sales revenue, $50 million cost, 50 million sales cost. This is given from year 1 to year 4, and HP need to spend 200 million for R&D. So R&D is a one-time expense, and along with $400 million equipment purchase. So we're gonna use straight line depreciation method for this one with the expected life of 4 years. So we're gonna treat 400 million divided by 4, $100 million expense every year from 1 to 4. The corporate tax is given as 20%, and required net working capital is 10 million at least equal to 1 to 3 and 4. The net working capital will be recovered at the end of t is equal to 4. So in terms of computing change in net working capital, you see the increase at t is equal to 1 and it will be reversed. And the project cost of capital discount rate is given as 10%. Given this information, this is just simple example of what we discussed in the class. Simpler version of the Cisco example. Given that information, you can get all what is sales revenue, operating cost, admin cost, R&D cost, equipment expenditure, depreciations. We got all this information. Given all these informations, you're supposed to compute free cash flow of these things. The implementing this project, introducing new laptop. So once you compute unlevered net income, you need to make an adjustment to that to compute free cash flow. You need to choose the right cash flow you got from the given informations. This should be very easy. So once you compute sales revenue, everything using this table, and you get the free cash flow number, then scan the QR code and select the correct answer. Because this is just simple extension of the example we discussed in the class, I'm not gonna solve this one in the next week. I'm gonna just provide the solution for this one next week.